If you're trading a funded account or you're thinking about getting one, this video is going to absolutely change the way you look at risk and ultimately how you get and stay funded. Now, this is really the reason why so many people blow up their funded accounts. So if you want to get a funded account and stay funded, stick around, hit the like button, and let's get into it. If you're new here, my name is Houman and I went from working in the Silicon Valley to building a seven-figure e-commerce business to now becoming a full-time day trader. And this channel is all about documenting that journey and sharing everything that I learned along the way. So if that's something that you vibe with, definitely go ahead and subscribe to the channel and join me on this journey. Before we talk about how to structure risk, we need to first talk about something that most people don't want to hear, which is you have to accept the risk before you put on each trade. Now, the way that most traders think is that I'm going to go make $500 today, and that's really a losing mindset. Instead, we should be thinking that in this trade, I'm going to risk $200, and if it goes against me, I'm fully okay with that. I have already accepted that risk. In my opinion, the number one reason most traders fail is that they don't fully accept the risk before they put on a trade. So when the trade is going a little bit against them and they start seeing the red number on the P&L, that's when the emotions kick in, that's when they start to panic and make irrational decisions. So it's really important that you find a number that you are comfortable with losing if the trade goes against you. That way you have fully accepted the risk that you are putting on. Now, at the same time, the number also has to be significant enough for you to care, right? So if my risk per trade is $5 and if I lose a trade, I lose $5, and if I win a trade, I make $10 and I don't really care about that, that means the number is too low. So this number has to be something that you accept fully, but at the same time significant enough for you to care. Now, the second important thing is that the way you approach risk for a challenge should be different than the way you approach risk for a funded account. And the reason for that is simple. The two are drastically different, right? The reason for a challenge is for you to get to that funded account as soon as possible. And when you have a funded account, your whole goal is to preserve that funded account, grow it, and take payouts from it. So we really cannot be trading both of these accounts the same way. And on top of that, you have the resets with the challenges. So for example, on a Top Step $50,000 account, for $49, you could reset it. So you have the ability to be a little more aggressive on the challenges because you could easily reset it for $49. Whereas by the time you have a funded account, you have gone through the process of getting the funded account, paying the activation fee. You have so much time and money spent that you really don't want to be that risky. You want to dial that back a little bit and play it more conservatively. So now let's talk about how to structure risk the right way. Now, most people look at funded accounts in the face value. So they say that I have a $50,000 funded account or a $150,000 funded account, and I did that as well in the beginning. But we should be looking at our maximum loss limit, which is the number that once we hit, we lose our challenge or we lose the funded accounts. So in reality, that $50,000 number is more of our margin, is how many contracts that you could buy, and our focus should be on that maximum loss limit. So the way I come up with my risk is how many losses can I take before I hit that limit. So for example, on a Top Step $50,000 account, you have a $2,000 maximum loss limit. So if you accept the fact that if you lose 10 times in a row, you will lose the account, then your risk would basically be that $2,000 divided by 10, which is $200 risk per trade. So with that, you know, if your stop loss hits 10 times in a row, you lose the account, then that is the risk that you are willing to take. Now, if you feel like that is a little bit too tight, then you might want to do 20. So in that case, you would divide $2,000 maximum loss limit divided by 20, then you are risking $100 per trade. Now, if you feel like 10 times in a row is too much, that you barely have that many and you want to take on more risk, then perhaps you're going to be doing 5. So in that case, you divide $2,000 divided by 5, then you have $400 risk per trade. So it's really based on how much risk that you are willing to take. And that number also changes depending on whether you're trading a funded account or a challenge. Because in a challenge, you might be more aggressive. You might say that, okay, if I lose 5 times in a row, I'm just going to reset for $49. So then you take on $400 risk per trade. So with a funded account, you might say, okay, I'm going to give a little bit more breathing room, that I'm going to take the risk of 10 times in a row. In that case, you go with $200 risk per trade. So with this method, you're kind of working backwards. You first think about your maximum loss limit. Then you think about how many losses in a row you're willing to accept accept, and with that you come up with your risk per trade. So this way you have already accepted the risk per trade, and when you put on a trade, your emotions don't kick in, you don't think about the money, the P&L, you have already accepted the risk, and that way you focus on your strategy and taking good trades and you let the rest play out. So now let's go through a couple of challenges that I've completed in the past, and we'll talk about how that risk management comes into play. Now these are top step $50,000 challenges with the maximum drawdown limit of $2,000. Here, as we could see, that my average losing trade was a little bit over $200 and my average winning trade was a little bit over $400. So clearly I had a little bit more normal approach. I was giving myself 10 losing trades in a row before I blew up that challenge, right? So $2,000 divided by 10, $200 per risk. So this is the approach that I was taking to this funded account. And as you can see here, there is a nice rising equity curve, which is what you want to see. You want to see a little bit of a dips here and there, but in general, it is a rising equity curve. Now, this challenge took me 11 days to complete with a winning day percentage of 82%. So overall, pretty good, 11 days to complete it. And in comparison, here's another challenge that I completed with a little bit of a different approach. So here, as you could see, that my average losing trade was $400 and my average winning trade was closer to $600. So clearly here, I took on more risk. So I was giving myself $400 risk per trade. So 5 losing trades in a row basically mean not passing this challenge. So here I took on more risk, and as we could see, the same equity curve that is rising, but I was able to complete this challenge in half the time. So instead of 11 days, I was able to pass the challenge in 5 days, about the same winning percentage, 80 days winning days. So everything else is the same. It just I took on more risk, but I was able to complete the challenge in half the time. So that is kind of the, the give and take here, right? You take on more risk, but you're able to pass the challenges more quickly. But at the same time, you risk having to reset the challenges. So that is something that you would have to think and see which one you're more comfortable with. And depending on the market conditions and how you're trading, this could change. So sometimes when the market conditions are better, I'm feeling really good about it, then that's when I approach this challenge with more risk. But if the conditions are kind of normal and I'm trading okay, but not that amazing, then I will not take on as much risk and just give myself a little bit more wiggle room there to pass these challenges. Now, to come up with this number, you actually need to be journaling your trades to have that data. Otherwise, you're trading blind and you're pretty much gambling, right? So the 4 most important things to know is, first of all, what is your average win percentage? What is your average risk to reward ratio? How many trades you take per day and how many trades you take on average per week? So once you have that, then you could work backwards and find that risk per trade number that we talked about. And then once you know how much you're risking per trade, it's actually really easy to calculate that on TradingView. So when you come into TradingView, there's actually a tool here called long position or short position. And in there, you could input how much you're risking per trade, and that will calculate your lot sizes for you. So I'll show you one of the trades that I took in my funded accounts last week. This is the hourly chart. And when I came in, I saw this nice liquidity grab. And I saw that we have targets right above here at this resistance level. So when you come in here and you do a long position and you want to get in on the break of that 1 hour candle, so you could actually double click on this tool and put in the lot size as 1 and then put in your risk. Whatever you're risking per trade, you can actually put it on there. So here we put $200 risk, and then here automatically calculates the quantity of lots for you. With this one, you want to do a round number because you cannot do partial lots. In this case here, I would, for example, do a 2-lot risk. So as you can see right there, we have a 2-lot risk, and then you could drag that down to where the resistance is, which is right there, and you could see that risk to reward ratio here. So in this case, if I was to take this trade, this would be a 2-lot trade, and that would have a potential of 1.8 R on my trade here. So then once we let this go forward, we could see that the trade actually played out in our favor. My TP for this trade was actually hit right there. So that's basically how you figure out your lot size. There's no guessing, you have the tools, and once you know exactly how much you're risking per trade, you could use the tool in TradingView and then calculate it automatically. That way you're risking the same amount on every single trade. Alright guys, so in summary, number 1 is that you have to accept risk before you put on a trade. So if the loss makes you nervous, then you need to size down. If the loss is not significant enough, then you need to size up. Number 2 is that challenges and funded accounts need to be approached differently. 3 3 is that we need to work backwards. First, see how many losses in a row we are willing to accept before we lose that challenge or lose that funded account, and based on that, find that risk per trade. And number 4 is absolutely journal everything. Data is really the key and our edge in day trading. Now, at the end of the day, day trading is all about probabilities. If we want to last in this game, we need to know our numbers, stick to the plan, and most importantly, trade smart. So that's it for today's video, and I hope that you got some value from it. If you did, hit that like button, and if you haven't subscribed yet, what are you doing? Hit the subscribe button, join the family. We are on our way to 1,000 subscribers, and I would love to have you on that journey with me. And in the comment section, I would love to know your thoughts on this risk management that we discussed today and how you approach risk yourself in day trading. And I look forward to seeing you in the next video. See you next time.